The story of Kenya's housing market is that of two worlds. On one hand, a thriving real estate sector, but yet in another, a widening housing gap, especially in the low-income earners bracket. We spoke to various developers and government officials on what could possibly happen to bridge Kenya's housing gap. Take a look. Kenya continues to stare at a widening housing deficit. Every year, developers place about 50,000 housing units into the market against a demand of 200,000 units. The total housing gap stands at a staggering 2.5 million units.
Of course, there is a boom in the market, and for it to be sustainable in future, I think the private sector and the government have to do more to target new, the general market, so that we can avail houses to the masses. I think going forward, one of the best things we should pursue maybe is look for new technologies, like maybe prefabs and prefabricated houses, so that the cost can come down and the mass can also have access to more affordable housing.
The purchasing power of Kenyans lies right at the center stage of the housing crisis, especially in the urban areas. According to the 2016 first quarter housing index by House Consult Limited, house prices have continued on an upward cycle, hitting at least 14.6% increase so far into the year. Worthy to note that about 75% of Kenyans living in urban areas earn less than $250 every month.
If you talk about a house, 3-bedroom, for example, with 6 million, and you give them a loan maybe for 10 years or 15 years. The question is it affordable? Can they afford? That's the issue.
So we have a big challenge as the stakeholders in the industry to still find ways under which we can minimize this cost. We hail the ministry for their efforts in steering the industry and appreciate the ongoing digitalization of the land registry. However, a lot more need to be done, as there are still married challenges affecting supply to the low-income groups where the demand is high.
From a Kenyan developer's perspective, the cost of inputs is too high to guarantee a house below $10,000. Specifically, the cost of land in Nairobi has grown by 600% in the last decade, while interest rates remain at double digit at an industry average of 17% at the moment.
Today, 1 acre of land in Kaimenyi, Westlands, Lavington is around 350 million Kenya shillings. In places like Upper Hill, it has reached over 600 million. Cost of finance keep going higher, making development expensive and end financing out of reach of most of our citizens. Bureaucracy in approval processes. Developers have to contend with several institutions.
Cost of financing, we are talking about 17–18% and above, which is very expensive when you're doing something for long term like real estate. So basically those are the key factors. Number 3 would be we are not appreciating technology. It's still like Kenyans or Africans in general, they are slow to take on construction technology. For example, when we are going to show somebody a house in Mombasa, the first thing a man does, he knocks on the wall to feel the strength of the wall. So they still believe in the mortar and brick. But if you go in the rest of the world, you see they are doing fabricated, they are doing with all the kind of the new technologies, the foam system, precast systems and all those systems, which here in Africa we are not agreeing to them. But it will take time before we catch on, and it's a big bother for now. But till we catch on with the technology, there's no way we can have affordable housing.
Nevertheless, the middle and upper segment of the housing market continue to give good returns on investment for investors. For instance, average annual return on real estate investment in 2015 was 23%, begging the question whether developers should consider lower profit margins and instead increase resources to the scarcely served low end of the market.
Lowering our margins is a way. Other factors might also include coming up with an all-stakeholder forums or engagement, so that we can come and harmonize the private and the public sector, so that government on one side may give tax incentives and developers are compelled to not of course controlling them, but are persuaded to lower their margins so that the projects that affect the lower segment of the market can also be uplifted.
Developers, honestly speaking, they're in business. They're in business to make money, and they take big risks. Some of the developers even put their houses for mortgage. They mortgage their house to go do a project. Now telling that guy who's taking a big risk like that to do a charitable or a pro bono project, it won't work, of course. They're in there for profit.
With minimal forthcoming possible solutions for the low-income earners, focus is now shifting to government-driven community housing projects, where the Kenyan government plans to construct 300,000 units by the year 2017.
Some of you have wonderful products which I call community price, because they are affordable. Where you are saying one house, for example, one single unit, will cost in the region of 600 to 1.1 million. Fantastic. I think that's why we should go. And for that also to happen, I hear what Daniel Ojijo was trying to emphasize, the need to provide incentives